Fed meeting, of course, the Federal Reserve expected, as we know, to raise rates by 50 basis points. Our next guest thinks that'll be it. That might be the last hike we see for a while. He called it a contrarian take, the most contrarian take in a recent tweet. Yeah, I think that's accurate. Josh Wolf is with us now, Lux Capital co-founder and managing partner. Josh, good to see you. Lay out your case here.
You know, it's interesting. The last few segments you had, you were talking about ISM is down. You were talking about oil prices are up. Consumer discretionary is down. I actually think consumer discretionary is going to continue to go down, not so much for rising prices that people can't afford it, but demand was pulled forward during COVID, and people don't need their extra Peloton. They don't need more clothes. They don't need another computer. They basically pulled forward years of demand. Consumer staples are getting crushed. And these are the poorest people in the country who are the most hurting, and they've got food and fuel prices that are rocketing. And I think we've got a time where you've got 11.5 million open jobs. It looks like we have full employment. The Fed's double mandate of price stability and full employment means that, okay, they're going to try to attack inflation. But I think this is mostly a supply issue. I think this is mostly an issue also of a transferred wealth effect. For the past generation, you've had this Goldilocks expectation of soft landings every time the Fed gets involved. And mostly, even though they're supposed to manage price stability and employment, they've been managing the stock market. And the reality is they transmit this wealth effect. It adds collateral to borrowing and margin accounts. Companies and CEOs and boards are buying stocks back, and they're doing it at ever record valuations. All of this distorts valuations horribly. Everyone has had this Fed put mindset for the past decade, just buy the dip. And so basically the cost of capital was too low for too long. And the lower the cost of capital in my business, we were beneficiaries of this. So I'm being really intellectually honest here that, you'd have these 20-year far out fanciful ideas that basically became these 20-month frenzied projects. And now you see this sort of excess and exaggeration and the absurdity and the frauds that are starting to come out in the tech world. And you can see this, by the way, in the TV shows, right? You look at the Uber show, Super Pumped, and the WeWork, We Crashed, and then the Theranos story in The Dropout. Those were all excess, exaggeration, and absurdity. So right now you've got the Fed basically trying to land a plane. And the risk of oversteering, where you've got passengers in the back, some of whom are suffering from these consumer staples, and they need painkillers. They need rubbing alcohol to heal their wounds. And it's sort of a mixed metaphor here, but they need low rates. And they got to make mortgage payments, and they're taking out more credit, and they got to pay for basic food and fuel. And then you've got others on the plane who are basically partying, and they want the pills and the alcohol just for continued speculating. And so you have a situation where the Fed was too slow to act when the economy was growing, and now it risks being too fast to act when the economy is slowing.
The Federal Reserve comes through on their threats to fight this 40-year high inflation by announcing the sharpest rise in interest rates in over 20 years. The Fed's benchmark interest rates was raised by 50 basis points, a 25 basis point increase done in March. The hike was the largest since 2000, plus brings it to 75 basis points to today. The first increase since December 2018, more to come as the Feds continue to threaten with more aggressive hikes due on June 1st. Stay tuned. Let's see what's going on and how we can price this in and prepare for what's to come. Editor, roll clip, fair use.
75 basis point in an increase is not something the committee is actively considering. What we are doing is we raised 50 basis points today, and we've said that, again, assuming that economic and financial conditions evolve in ways that are consistent with our expectations, there's a broad sense on the committee that additional 50 basis point increases should be on the table for the next couple of meetings. So we're going to make those decisions at the meetings, of course, and we'll be paying close attention to the incoming data.
Federal Reserve raising the target range for the federal funds rate by 50 basis points to a new target range of 75 basis points to 1 percentage point. The Federal Reserve increasing says ongoing increases will be appropriate. The Fed will begin to reduce the balance sheet on June 1. It will ramp up the balance sheet reduction over time. It's going to begin with $47.5 billion in balance sheet reduction through August, and then after that 3-month period, it's going to reduce the balance sheet to allow the runoff of $95 billion a month as expected, and that'll happen beginning in September. That'll be a total of $60 billion in treasuries running off the balance sheet every month, $35 billion in mortgages. The Federal Reserve says household and business spending remains strong. job gains have been robust. The Russian invasion of Ukraine likely puts upward pressure on inflation and weighs on economic activity. A very quick analysis, guys. There's one sentence in here that was a little more dovish than I expected, and a lot of other observers thought there'd be a line in here about the Fed moving expeditiously towards neutral. It doesn't say that. It just says anticipates ongoing increases will be appropriate. Doesn't say how much. We're going to have to leave that for Fed Chair Jay Powell, and whether or not he'll put some character on the pace and amount of tightening to come from the Federal Reserve.
Chris Rugaber and Associated Press. Earlier, you just said that if necessary, I think were the words that you would, or if it turned out to be necessary, or you said it's possible that we'll need to move policy to restrictive levels. Given where inflation is and the hot economy is, or certainly the hot labor market as you described it, why still the hesitation? I mean, shouldn't it be, what else do you need to see in order to determine that? Wouldn't the Fed naturally be looking to go to a restrictive level at this point? Thank you.
So if I said necessary, I meant to say appropriate. We're not going to be erecting a high barrier for this. It's more if we think it's appropriate. You know, the point is we're a very long way from neutral now. We're moving there expeditiously, and we'll continue to do so. And we can't make that decision really today. The decision about how high to go will be on the table to be made when we reach neutral. And, you know, I expect we'll get there expeditiously, as I've mentioned. So it's not that we don't want to making that decision today wouldn't really mean anything. But I'll say again, if we do believe that it's appropriate to go to those levels, we won't hesitate.
Hey guys, it's Jose, your regular Joe Blow again, keeping an eye out and my ears open to how to move in these financial times. Guys, they are giving us time to move accordingly. So this is a blessing in disguise. They have been using credible threats for months now before they even pulled the lever. So we had from March to now to May 4th to take action. So there are no excuses moving forward, guys. Let's continue to thrive and build in these coming hard times. Hope for the best for everyone consuming this content. My job will always be to bring transparency and clarity to the best of my ability, and pray you do the research and plan forward to build wealth and stay sturdy and build a strong foundation for you and your legacy. Thank you for sticking with me to the end. Stay free.
It ain't hard to tell. I excel, then prevail.